Hey all, let's get into our next part of merchandising where we're going to talk about periodic inventory. As I mentioned in, I think, the previous note, I don't really like to go through notes with a video because you have the ability to read and review on your own. You're going to be an adult soon, so you can read a slide. But I do want to go through some of the key differences in using a periodic system versus a perpetual system. So in the start of this unit, we were looking at a perpetual inventory system where there were some new accounts that we looked at. When we were buying inventory, we were using a new asset account called merchandise inventory. And then when we would sell, we would make a sale, we had a double transaction. The first transaction would show the sale, so it would be an accounts receivable or cash if the buyer paid cash. And then we would credit sales because we had a sale. And then remember, we had to have that secondary transaction to show that we had a cost of goods sold, and then a credit to merchandise inventory to reflect the fact that we had gotten rid of that inventory and sold it to a customer. So in this form of inventory valuation, it's called periodic, which means to do something on occasion. So we're not going to update our inventory every single time there is a transaction, and there are some key differences to how we are going to analyze and record the transactions in a journal for a periodic inventory system. So the first thing I'm going to do is I'm going to go down to what is, I believe, slide 5 for you, so you guys can read the opening slides. I'm just going to go through a couple of examples here. So you'll see here that we made a sale for $3,800. Now the sales transaction, what we are going to do is just show the sale. So we've made a sale for $3,800. In this case, it was on account. So just like you did at the beginning of grade 11 accounting, you have a debit to accounts receivable for $3,800, showing that we made a sale. And then we have a credit indicating that our revenue has gone up $3,800. So there's only one transaction. Had we done this in a perpetual system, we would have that second transaction. That would be a debit to cost of goods sold and a credit to merchandise inventory for, say it's $2,000 or whatever we bought the inventory for. We don't do that in a periodic system because we will update our inventory on occasion. So that's an important transaction for you to take note of. When customers return stuff to us, we are going to create something called a contra revenue account called sales returns and allowances. To be frank, I don't remember if this was in the last note, so let's go through it really quick. We create this contra, so it's a plus minus revenue account that works in direct concert with your sales account. So they work together. You cannot have a sales returns and allowance without having a sales account. So we know sales are a minus plus account. They increase with a credit. When a customer returns something to us, which they can do within their rights, we then have to record the fact that we have that inventory back, but we didn't make the sale. We create this account because we want to separate it from our actual sales account for control purposes, because if I am a manager or I'm a CEO of a company, I'm not doing the day-to-day accounting stuff. I'm not going to know if there were any sales returns and allowances. If I just have a sales account that would credit $3,000 in sales, and then there's a debit of $300, I would say I've got $2,700 in sales with no real story to it. We add the sales returns and allowances account for management and control purposes. So I now can look and say, okay, why are we having 5% of our sales returned to us? What's going on? Are our sales reps properly explaining the products and services that we are selling? Or is there a supplier that is maybe giving me products that aren't popular? Maybe they're defective. I don't know. So it allows me to be from a management perspective, to make some decisions, because I really do want to minimize those returns. So when you have a customer return something, you are going to have an account called sales returns and allowances. Okay, this is a big change here. When we purchase inventory now, we no longer have an asset account called merchandise inventory that we are going to record it in. We still do have a merchandise inventory account. We're just not going to do our purchases in this. So when we do a purchase of inventory and inventory only, we are now going to have an income statement account that falls under a section called cost of goods sold. And this is different from your previous note as well. But not to overwhelm you with too much information, I'll worry about a cost of goods sold section later. just know that instead of a merchandise inventory transaction when we buy inventory, we are now going to have an account called purchases, which is a plus minus account, and then accounts payable, or if I pay cash, it would be cash would be credited. So please make note of that we are now using purchases when we use a periodic system. And just like our customers can return stuff, we can also return stuff to our suppliers. So we will do the same thing. We are going to create a contra account for purchases called purchase returns and allowances. This will be a plus minus account, and it will show the net amount that we purchased. So we are allowed to return stuff, and when we do that, we just reverse the accounts payable, or we get the cash back, and then we make sure we have a purchase returns and allowances account. And then the last big change you're going to see is in a perpetual system, we just incorporate the cost of freight into our merchandise inventory. So if this was the previous unit or the previous note, it would be merchandise inventory 150 and then cash 150. In a periodic system, we actually rip out the shipping cost and record it as freight in to show how much we are spending on shipping. And that again allows us from a management perspective to see how the company is doing in terms of minimizing the cost of their shipping and freight and all of that stuff. So this slide here is probably far too small for you to see. Just know that that blue section we're going to rip out on its own, and it's called a cost of goods sold section. But again, I will do a video tutorial for it so that you can better understand that. All right, so that's it. The big takeaways is when we buy inventory, we now have an account called purchases, which is going to go on our income statement instead of merchandise inventory. When we make a sale, we only do one transaction. We do not have to do that second transaction that has cost of goods sold and merchandise inventory. All right, so I'm sure this is clear as mud. Take some time to work through this note, rewind this video if you need to, and then work through the exercises and discussions as per normal. And then always reach out if you have any questions. Good luck, everyone.